Hi, everyone. This is Kunal Varma. I am the CEO and co founder of Freo, and I'm here at the Founder Thesis podcast. Super excited.
You're a serial entrepreneur and Frio is your second venture. Let's kind of trace back on how you became an entrepreneur in the first place. If you could just give like a quick, what led up to you
Sure,
becoming an entrepreneur, a little bit of your background.
sure. I think I was always interested in doing something where I could see a bigger impact as an individual right out of my engineering days. I mean, on IIT campus as an engineer, we were all kind of split between taking the coolest jobs and like completely changing the world. And I think I was no different. So I straight away started working for an organization, and I worked for about 7.5 years. I really felt that if I were to really, put myself out there and be excited about waking up every morning and long term really feel proud about what I'm doing, then I had to do something much bigger rather than being an important but a very small cog in the wheel. I think with this completely vague idea of trying to make an impact, I decided that look, I think it's entrepreneurship is the way to go. So I think just as I had turned on the other side of 30, is when I decided to take that leap. And it started with the first so called project, which is like a small business right out of the school campus, which I ran for about a year or so, like a services business, marketing, service analytics, but nothing really great. But one box got immediately checked that I started making money very quickly as a services business. So that's when my first business started materializing, and I started realizing that it was not really about the money yet again, because I was making enough money, way more than I would personally spend. I mean, thankfully, my lifestyle had not upgraded too much. I still liked the same food and still liked the same stuff mostly. I then realized that I had to do something bigger, more structured. So I think the learnings from being an engineer, having worked in a professional setup, were kind of coming together in my head. And that's when I started my first real business, which then came to be known as TapStart, which was completely an education and talent analytics platform. That was a fun ride. It was a short ride, not more than 5 years, but it was a good ride, which came to a logical conclusion, starting from zero again, funding it myself, then getting a co-founder to join me in the journey when things started getting serious, and then doing all the right things in terms of making money, serving customers, and then seeing that there was an exit in sight and taking that exit. And once that happened, I knew that part unemployability and part having tasted what entrepreneurship was able to bring out in me, I realized that I was not getting enough. And I think the last thing that came to my mind was the amount of money to be made, or I had made, or I would make. Uh, Fortunately, I'd been prudent. Like I said, I've not dramatically upgraded my lifestyle, which allowed me to just be simple. So yeah, I think that's when the pieces came together in my head for the current business, which today we call as Frio. When we started off,
I want to,
again, it was
before
an
we
idea.
start
Yeah,
Frio, I want to zoom into a little bit of the TapStart journey. Uh, when did you feel that you have found product market fit? And I mean, this is again with the power of hindsight, because I'm sure at that time, even the concept of product market fit would have been alien.
yes,
And what was the product and the market? Just tell me that also. Was it
sure.
a
See,
B2B service or a B2C or?
it was the marketplace. The product by itself was a platform wherein we had created adaptive dynamic assessments for different professional areas. For example, a working professional working in a company would find value in using our platform in order to assess their skills on various areas. For example, digital marketing, equity research, financial accounting, operations theory. We had about 100 on a good day, we had 100 very good, powerful assessments built on technical domain knowledge created by experts of the industry. And with that, we had created an assessment system, just like a GMAT or a CAT, which increased in difficulty based on your capability as a professional. This allowed working professionals to evaluate themselves and match themselves to good opportunities from a work and upskilling standpoint. So we had a lot of investment done in content creation and assessment creation, which would be practical from a job standpoint. And on the other hand, this platform was also being used by institutions like corporates and then eventually the government to evaluate their employees or potential candidates based on the work areas. And institutions and then the government was willing to pay for this. And for individuals, we had provided it as a free service. So in that sense, it was a marketplace, a platform running as a marketplace where your revenue was a B2B model and consumption was B2C. But of course, the network effects were driving the value of the platform up. So this was the product, and there's a market, like a two-sided marketplace in that sense. I think I remember very clearly that around 2013, early 2013, is when I was convinced that we had product market fit. And the reason we were convinced about it is because we were able to consistently convince institutions, both corporate as well as academic institutions, that this platform would give value, and they were willing to write checks. And we started getting revenue in as a front loaded, like in advance. So let's say a corporate or an academic institution found value in the platform, and let's say the ticket size for, let's say, 5 lakhs. We started getting like 2 lakh rupees advance payment or 1 lakh advance payment, depending on the commercial model. And a 5 lakh revenue stream, maybe spread over a 1 month or 2 months, would start coming in upfront. So my working capital started getting addressed upfront. And once that became a repetition, like a 3 or 4 clients coming in, we knew that there was something which people would pay for. And that in our head was the sign of a product market fit.
Okay, interesting. And was there a focus on, say, technical, like say software and these kind of assessments, or psychometric assessments, or like what kind of assessments?
Yeah, we didn't do psychometric assessments at all, because psychometrics were being addressed by a lot of expert players in the market. There are these very well established psychometric assessments used by companies for the past 20-30 years, personality
like
types,
MBTI.
and MBTI, Myers-Briggs, and so on and so forth, 360-degree feedback. There are a whole bunch of them. And we realized that there was no incremental additional value that we could bring on the table. But functional domain skills, analytical skills, basically tradecraft in different domains, whether it is marketing, finance, operations, analytics, and different. So I would pick like 8 to 10 top domains. Within each of those top domains, we would break it down into 8 to 10 individual work streams. Like within marketing, there would be search engine optimization, there would be digital marketing, there would be performance marketing, there would be marketing research and analysis. Like that, in finance, it would be equity research, brokerage, and so on and so forth. So like this, we had picked 8 to 10 top work domains, and within those, we had 8 to 10 streams. So roughly around 100 plus. And we were on the path to, scaling this up. Probably every quarter, we would add 1 or 2 big domains, and within that, about 5 to 10 new stuff, while at the same time trying to keep the current content up to speed with the latest market trends. So that was the area that we focused on. And I think this did not have too much of a competition.
And what was your customer acquisition strategy? How were you doing sales?
Oh, we were very scrappy in that sense that, on one side, it was a lot of growth hacking, a lot of actually sitting and creating content, getting people to find us through inbound search engine optimization, traffic, backlinking, that kind of stuff. So allowing for organic discovery. And on the other side, it was actually approaching B2B, clients and customers. And that was a lot of actually, pounding the pavement, cold calls, getting dejected. So me and my co-founder would, on a typical day of sale, while, people from the outside think that it's so glamorous to like sell and negotiate, and we see all these movies, but a typical morning would be like we would get up, we would get into one of our cars with a fully charged phone, and we would open Google Maps, and we said, look, we have a list of these customers or clients that we're supposed to knock on the doors. Let's hit West or North Bangalore. And there was these 20 guys to cover. And if we had leads, we would go to them first. If we didn't, there would be a complete day of cold calls. So there would be a day of cold calls, meeting, pitching, trying to sell ourselves, trying to sell the value. And then, the objective of the meeting was to, first of all, not get insulted and thrown out, like turn the night in with some self-respect so that we have enough motivation to get up the next morning. That itself would be a win. And then sometimes the objective was to do a meeting so that we can get the second meeting, so that there is some incremental value, some sales pipeline can be built. And I think this is how, step by step, inch by inch, brick by brick, we created a sales funnel and we started converting. So we got academic institutions, we got companies, then eventually through our connects, everything, we got the government. The National Skill Development Corporation became our client on a retained basis. The Telecom Sector Skill Development Council and a couple of others, we got them empaneled, and they were using our platform across 400 cities for assessment. So, but this all happened after a lot of what I explained.
Amazing. How did you overcome that hesitation? Because you were an engineer who had worked in a tech role. From that to going out and doing cold calling or knocking on doors, hoping to get a meeting.
I think I think having good communication skills and being an very active part of the debate club in school was probably something which was hardwired into me. So I was always good with communicating, and having grown up in a family where there was a lot of importance given to how you communicate, how you speak with people, basic etiquettes, basic manners, actually played out to my advantage. Now I think that, growing up and even through your education, especially in today's times, one should over-index on that capability. Unfortunately, it was just something which was kind of part of me. But then again, I think working through tough problems, I think my first 7.5 years of working in a corporate setting, in a very intense work environment in hardcore semiconductor technology, the industry that I came from, working through really, really tough problems, working with very smart people, trying to put my ideas across. I think a combination of all of these things helped me to break a problem down, no matter how harsh it seemed at first. And then to say, okay, this one step, if I do this one step, then I can put my one foot in front of the next foot. So it always allowed me to create incremental progress. So it was not so black and white, fortunately for me, that, either I have failed or I've succeeded. So I could always see some progress happening. And that allowed me to keep going. That was one. I think partly it was also a little psychological. But, now that I have taken this leap, what should I really do? It's not like I feel bad because, this guy did not even, the assistant or the peon in front of an office did not even give me an empty chair, ask me for a cup of tea. Whereas, I'm far more worthy of that. I think there were a few initial weeks where I had these pangs of, dilemma, questioning myself and really my value. But I got over it. I think that's been one major life lesson, which I even follow even today, because that I on an average, in an average lifespan, I have more bad days than good days as an entrepreneur. But I learned something very early on, and that helped me in tackling this. So I kind of got out of, I didn't I had to get out of my own head. And okay, I'm an engineer. I went to IIT. I'm like, so what? I have to kind of move on and earn my lunch. I think eventually the world taught me this. So I think I learned that lesson, and fortunately, I was lucky enough not to be too thick-headed, and I just a little humble. So I think that helped.
Amazing. The interesting thing is that this space that you were trying to build in of non-technical assessments is yet to see any large player. Most of the large players are on the coding side, companies like, say,
Yeah,
HackerRank, HackerRank, and most of them are also earning more revenue outside India than in India.
true,
I think
true, true.
this, I mean, the space itself was possibly not one which had a lot of potential to scale in.
Takers, yeah, absolutely. No, I mean you're right. See, it's partly if you read the tea leaves of where we are as a country, there is no surprise here. Uh, Look, I think today, if we had continued that business, we would be part of the edutech sector. Who knows what would have happened during COVID and after COVID? Like, you can always second guess. Things could have been worse, things could have been better. Who knows? But I think there are some few key patterns, right? As a society, while I think there is massive awareness in certain parts of the society, wherein people are relying a lot on knowledge based careers, the value of skills is, I think, becoming more and more apparent. And there are lots of startups, institutions which are investing in both customer education and real products, which is excellent. But I think, yeah, I mean, the value has been much less specifically for this. And it's partly because if you look at how developing societies versus developed societies operate, you will see some few key differences. One pattern you would see that in a developed economy or a developed society, people consume a lot of services. Whereas in a developing economy or a developing society, we still are very, very large consumer of goods. We're not yet large consumer of services, right? So we don't want to pay for convenience, which is a service. We still want to pay for the good, like, goods, like, so yeah, and hence, for example, I will buy a product, but I will not value the service as much. If I'm charged extra for the service, I start questioning the relevance of that service and think, what difference does it make, boss? Like, ultimately, if I get it, I will take it, obviously, because I want that also. But I'm not going to value it so much, which means I'm not going to put my money where my mouth is when it comes to services, because we are still like a developing society and a developing economy where we value goods far more than we value some services. Again, it's not black or white. A lot of us value convenience and time far more. But like I said, if you were to use some broad strokes, I think that's where we are, and I think that's one of the reasons why a lot of skills and skill sets, you would still see that like a far, like a huge, like a miles to go before you see same amount of value being placed on that as against an e-commerce website where you could actually buy goods immediately because you saw it in a movie or you saw the Western markets or you saw an ad. I immediately want that new shiny thing. But I'm not sure I want to invest so much on my skills because it might pay off 8 years, 7 years from now. Not so much. I think that's the reason, I guess.
Though I would argue the B2 side of your business is just a distraction, right? I mean, why even bother with it? Because assessments generally are of value to employers because it leads to meaningful reduction in wrong hiring or time taken to hire.
Yes.
Both of these are meaningful value adds.
True. I think, and hence we were very clear that who would see this as valuable enough to pay for it. I think this was very, very clear in that startup, and it's so amazing that this is almost like first principles. If you have somebody paying for something, that is ultimately the unfiltered definition of real value. No matter how much I can say, no, there is value in something else, but people are not paying for it. It's just the way we are wired. I mean, we place value on something when we are willing to abandon something for it, in exchange for it. And I think today, the most precious thing as a society that we value is money, not time yet. So forget about people spending time. Who is willing to spend the money? And that's the strongest, I would say, unambiguous indicator of real value and the real indicator of product market fit or a success. So B2C was needed, that site was needed for, actually creating value at a consumer level. Because if I could not see individuals using the platform, I could not convince the corporate that the individuals that you interview or you evaluate or you put through for an appraisal will actually benefit from it. The sell would be very hard, and it would be a sell. It would not be convincing. Right? I could not say with a straight face that this is a valuable platform, use it. The moment I saw B2C uptake, the take rate going up, I was very convinced. I could go with a straight face and talk to my clients that, look, this is a real value, and you got to try it out. And that also gives you the conviction to tell people, why don't you try something out for free for some time? It's like warranty, right? I mean, you go and buy a product, and a product with 10-year warranty versus a product with a 6-month warranty. It gets you thinking, like, why is this guy willing to give you 10 years warranty? Because he's far more convinced about the value of the product. Very similar here. So I think it played a role, but the ultimate bang for the buck came from B2B side. So I think you're absolutely right in that. But that was the role to be played.
Interesting. So did you actively go out looking for buyers, or it just happened that you were approached by a strategic investor, or like what happened? What led to, because most founders, while they're actually running the business, don't think of selling out.
Yeah.
It's a very rare founder who is able to dispassionately say, look, this business doesn't have legs, I need to exit.
True. Now, depending on how emotional I get in explaining things, this answer takes like different versions. And as much as I would like to sound very smart and intelligent and calculated about it, let me tell you that it just happened. It's just one of those things which, like, now I have learned with enough experience in my life, that a lot of things, they just come to you, and how you see it then decides whether it is a distraction or an opportunity to you. And I think that at that time, there was a mix of a few things happening. One is that we were pretty convinced that the way we were scaling up the business, it was getting more and more difficult for us to see this business becoming like 100x the size. Like, would I have like 100 times the number of corporate clients or institutions willing to pay the same amount of money in a finite amount of time? Maybe there would be. We didn't see it. And I needed to see a line of sight. While it was growing, I was already profitable. The revenue was running into crores. I was already profitable as a business.
You had raised an angel round as well.
We had raised an angel round, and we were profitable after raising I think within 1.5 years of raising the angel round, we were profitable. So I think the angel investors, who obviously, kind of bet on us because they partly believed our story, and partly because they were just like very good people who wanted to bet on a future entrepreneur. They probably saw some part of themselves in us. They kind of believed in the decisions that we would take because we had turned the business profitable. So we saw an opportunity of, some client of ours which is using this would probably be willing to take it off our hands. And at the same time, we didn't see this becoming 100x. And by this time, we had started asking these questions. And when you jump into a business as a complete greenhorn, you don't really ask these questions. But I think a few years into it, you start asking these slightly bigger directional questions. Like, is it the right boat that I'm rowing? Is it the right space? Like, no matter what space I choose, I'm going to work as hard. So is it the right space? And so I think by this time, we had developed some entrepreneurial maturity to start asking these questions. And the answer is not too obvious. And that got us thinking, and something came. And then we said, look, the opportunity cost is also there. So it was either maybe letting somebody take it off our hands, or it was then pursuing it further and raising an institutional fund round and then pushing forward. And we did not choose to take an institutional funding round. We were probably 2 months away from actually getting into an actual term sheet or institutional funding round. And we didn't. And we decided that, look, somebody had an interest, and we said, okay, let's figure out the next thing to do and let's take it off our hands. And I think that's what happened. But I think the optionality was there because we were in the money. If we did not, I would not be able to have this conversation with my investors of that time with a straight face, because I would have probably not had that self-respect. Said, look, I took your money and then I want to like give up. Sounds like a give up because when you say I don't want to do this, but I had made money and I knew and I told my investors that, this is where the options are. And they said that, look, we invested in you to see if you could make it successful. And there is a line of sight for us getting an exit without taking a haircut. Well, you guys decide what you want to do. I think that's how it all happened. And then we kind of moved on.
Who acquired it and for how much?
There was an institutional client out of Southeast Asia who bought it, but it was a product sale. They bought the IP. So we retained the corporate entity in India, but they bought us the asset of us. So it is not a complete company strategic sale. But they bought off the IP. So it is an asset and an IP sale while we retained the corporate, which then took us 3 to 4 years to wind up and shut down. But the asset was bought over.
Okay. So, now you and Anuj have got an exit. You probably have some cash in hand. How did you decide on what to do next?
So, the main thing that came in front of us was that we wanted to do something bigger. And the reason why it got us thinking on our older business was because we didn't see it becoming too big. And we were like, look, if I keep hustling while knowing at the back of our mind that it cannot become as big as something potentially else could, then maybe we are doing injustice to ourselves. So I think the question always was that, is this going to be big enough? Am I going to be bigger enough? Am I going to be putting my 100%? Am I going to really create a massive footprint? So I think those were the questions we were asking. And at the same time, when we were taking TapStart off our plate, we kind of brainstorming about what else. And our third co-founder, Bala and Anuj and I, we kind of all put our heads together, sitting over I don't remember if it was a coffee or a beer, but somewhere in a late afternoon on a weekend, sitting at a restaurant by the poolside, and we were talking about what next to do with our time. All of us still had the best years ahead of us. Obviously we are not like 20-year-olds, and we were like mature enough. At the same time, we were not looking at retirement. We had like a few decades to go. So we're thinking, okay, what next? And I think the whole conversation around how things are evolving in the Indian ecosystem, India stack, Aadhaar coming in, changing the landscape of how Indians would look at data, Indians would look at transaction. This played a key role in seeing that our day-to-day lives, especially in terms of how we dealt with money, would change dramatically with all of this happening. And that pushed us in the direction of financial services. And then applying our native thought process of technology, problem solving, business, consumer thinking in the domain of financial services allowed us to germinate the whole idea of creating the business. And there were some bits and pieces. Bala already had some kind of an idea framework in his mind, and then we all put our heads together. I think one thing led to the other, and there was like a phase of trying to run 0 to 100 miles per hour sprints every week, because you're trying to figure out, should I work, should I not work, what should I do, talk to customers, explore opportunities. At the same time, you wanted to slow down because you wanted to make sure as an entrepreneur that your next gig has learnings, right? You don't want to have this deja vu feeling that, oh my God, why did I not think of this, having gone through this 3, 4, 5 years ago. So we wanted to slow down in terms of judgment and decision making. At the same time, we wanted to run super fast and exploring all aspects. So it was chaotic, fun time. We were on a high that it's something exciting, and I think that intellectual adrenaline pushed us to get clarity that financial services with a technology flavor to it, which is fintech as we call it now, for Indian consumers, for the Indian market, is where we wanted to operate. So I think as long as that became clear in our head, everything from there on kind of fell in place. Talk to customers, talk to suppliers, figure out the nuts and bolts, the product and economics. And then I think the starting point became clear. And I think that's how it's all put together and came about. And then,
And
now
Bala's own
here we are.
background is he was part of, I think, Nandan Dilkani's that team which set up the Aadhaar. So he had
That's
a
right. That's right.
deep understanding
right.
of
Yeah.
the evolution.
Yeah.
Hmm.
Yeah, I think so many things come together, right? I mean, you realize that, there is no silver bullet. Many advantages, small or big, uh, add to that mix. And Bala's exposure, understanding, having been an ex-entrepreneur and an investor himself, having worked here, and all of us bringing different perspectives put together, I think gave us some natural advantage as a team. And we kind of leverage that.
And why lending? Did you think of other ideas also, or like lending was like the big market, the big whale?
Yeah, it was the big whale. I must be honest about it. But it was also the toughest one to go after. I think today Freo is far more than lending. We started as a lending only platform with the MoneyTap brand name, and then we created Freo, which is a complete digital banking platform today, where lending is just one vertical. But back then, we very clearly understood that the biggest demand, biggest need, biggest area of impact would be credit, and we could do justice by not only bringing our thinking, but actually creating a product that we thought customers would value several times more than what they were getting in the market. So we saw that we could actually create a product which was maybe, I don't know, maybe, for the lack of any other word, 10x better. It was not just incrementally better than what a regular consumer was getting, but could be 5x, 10x better. So we created the concept of a line of credit, a credit line. And the technical solution that we created for putting together a line of credit on a smartphone and an app, the entire complete architecture and flow, we actually filed a couple of patents for it as well, because we are the first company in the country to go after it. So I think product innovation was at the heart of the confidence that we got that, look, this is the right space to go after. Not just because it was very big. That's not always the best way to look at a problem. But one framework was that we could create a dramatically better product. The other framework was massive opportunity, demand. Third was that financial services in general and credit particularly is not a winner-take-all market, especially in most developing economies, even in developed economies, but particularly in developing economies, because it's still a distribution game. It's not yet a game of financial spread, wherein you're trying to minimize your cost of capital from 3% to 2%. We are still a distribution play. Financial access is like glaringly missing. So those things played in our favor, and that's how we started with credit.
And how does a line of credit work? Because at that time, I guess banks would either give a loan of X rupees, or a business could get like an overdraft facility. But for a consumer, a line of credit was not really a thing which banks did. And you needed a bank to run the product, right? Because you did not have an NBFC license when you started. And
absolutely. So the way a line of credit works, let me address that part of the question first. So I think you rightly mentioned like an overdraft facility. It's conceptually similar to that, right? So every business gets like a line of credit from a bank saying, okay, I have a factory as a company and I'm trying to run machines over there. Every month I need some access to capital. So let's say a business says that I want access to maybe 1 crore of capital. But some months I might only use 50 lakhs. Maybe 6 months later, I might use 70, 80 lakhs. Sometimes I might use 1 crore, depending on demand and supply business cycles. But I want access to that pool of capital, whether I use it or not. So essentially what every customer could also have is the same value. Saying that, look, you have access to a certain high amount of money. You don't need that money all the time. Today, what is happening is whenever you need to borrow, you go for a personal loan. But most people in India, like 80% of people in India, don't need personal loans all the time. our needs of money vary in size. So a regular family, a middle income, middle class family living in a tier 1 or a tier 2 town, sometimes might need money for a medical emergency suddenly. Credit cards may or may not be accepted at that point in time in an emergency. You might need money because you need to pay a deposit on your house or a rental deposit. School fees is coming up, and schools don't take credit card swipe. They don't have a machine like a digital store, like go and swipe your credit card on a fees, right? And not everybody uses online and everything is working. It could be a wedding in the family, and you need to have a 6-month planning on capital. So you need to book the venue 6 months in advance. So you need to pay a deposit. Then maybe 2 months before you need to pay the caterer, and 3 weeks before you need to pay the florist. And on the day of the wedding in the morning, when the guys show up, the infrastructure guys show up, they need another installment of down payment because they won't start your work. And then after the wedding is completed, the next day guys will show up to take the balance payment. So you see how the needs of a family vary. This is very different from the way a structured personal loan offer works, where the bank said that, look, I can give you a minimum personal loan of 2 lakhs, 3 lakhs. Below that, I cannot give you because the interest I will earn on it is not enough to cover my costs. I need to pay for the branch, people, forms, everything. And the cost of KYC, credit score reporting, blah, blah, blah. So banks could not fill this gap or a need. So the only option that people had was to somehow struggle. Go ask a family member, ask your uncle for money. But how many times will you ask that same uncle? Your social capital is depleted. You go to an informal money lender, but the rates are exorbitant. And people are inherently good. You realize that, like not everybody is out to take the money and run away. People inherently are not bad. They have genuine needs and they're okay to pay it back because they want to retain their place in society. They want to retain the trust capital that they have built in their environment. So they are not inherently bad. So they will pay you back. And they understand that they will have to pay interest and they will pay it to you. But you need to treat them with respect. You need to give them that value. So once we understood this part of the problem and the customer psyche, after talking to a lot of people, banks, we put the product together saying that we will bring this convenience to every consumer on their smartphone, where they can download an app and go through a digital process where they don't need to take off from their office or leave their home, walk into a bank branch, stand in the queue. They can download an app, go through a process, and this is where India Stack, Aadhaar, digital KYCs all helped us. And they could apply just like they would for a personal loan. But instead here, we would give them a line of credit. And if they got access to a line of credit, now they could keep it with them for 2 years, 3 years. And whenever they needed to borrow money, they could open their app and say, oh, well, I have a 5 lakh rupee line of credit today from Freo. But today I need 35,000 rupees. So let me enter 35,000 rupees on the app and let me choose my repayment plan. I can pay this back in 6 months or maybe 3 months or maybe 2 years. All those options show up on the app when you're deciding how much money you want to take from that line of credit. At that time, you choose your payment plan and you confirm. You get the money instantly in your bank account. And as per the payment plan, you can start paying back every month. And as you start paying back every month, your limit gets topped up. So like a credit card or like an overdraft conceptually, but very affordable, convenient, and I would say flexible. And people needed this flexibility at their convenience. You couldn't make them jump through 100 hoops and, stand on your head and do yoga. And then only I will, give you this. No, it had to be flexible. It had to be convenient. And at the end of the day, it had to be affordable. So when we were able to put this together, I think the customer value proposition was crystallized. But it spoke to all the banks. And I would say 90% of the banks' conversations that we had went nowhere. All bank CEOs that we could get access to, that we are, or senior management, everybody told us that this was a ridiculous idea. Nobody wants a credit line. No Indian consumer understands credit line. People only understand personal loan. People know the trust of a bank. Why would they take anything from any digital app? So there were a whole bunch of typical incumbent driven reasons. We still decided to go ahead because we had first principles conviction. We just needed to convince one guy, and we got somebody to work with us on the bank side, and that's how the journey started.
The bank made this product for you, like it, because this was not like a pre-existing product, so they would have had to.
Yeah,
Although
yeah,
it was
we had to
similar
co-create. Yeah, we had to co-create the product actually with them, which is going so like countless whiteboarding sessions, architecture diagrams, money float conversations, understanding compliance, understanding money movement rules of RBI, of banks, of payment systems, understanding tech limitations of internal banking systems. I think we had to put all of these together. So we were constantly fighting like like a moving Rubik's cube. We do one thing and something else comes up. Oh, we didn't think of this and we didn't think of that. So it was a co-creation of a brand new product. And we were fortunate enough that whichever bank partner agreed to work with us, the individuals on their side were as excited about creating this product as we were. And it seriously would not have happened without them. So it's like so many people's motivation and goodwill and hard work and commitment came together, and we put like a 100 pieces puzzle suddenly together, and it looked like, well, this is so simple. But in creating it, we had to like we really had to do yoga on our heads. But it came together. Yeah.
Is there a reason why you're not mentioning the bank partner's name?
No, not at all. I think so this was RBL Bank. And we have very high regards for the team in RBL Bank that helped us. Of course, the bank is a very large institution, but
RBL is very fintech friendly.
They are. Now I think a lot of banks have taken that stance because they've realized that, yeah. No, I think partly that and partly they see the genuine need for it. But yeah, I think the specific team members within RBL Bank that worked with us in co-creating, I think we owe a lot of our initial success to that team.
And in this whole transaction, does the money hit Freo's account as well, or it directly goes to the customer from RBL? Like
directly from the banks, as per RBI's and NPCI payment policies and the money movement rules. We did not have an NBFC license in this equation, so we obviously had customer experience, journey controls, and a lot of other things working where we were the driver's seat. But the money flow was directly as per RBI regulated norm, which is going from the bank to the customer. And we had to manage the experience of all of that, and also deal with the transaction complexities of managing the app information, the backend information. So a lot of technical server integrations, but money flow was not through Freo. It was directly from bank to customer, customer to bank.
And so you would have been like a digital DSA for the bank, like banks have the DSAs who source loans for them. So you would have been like the first of its kind.
Digital DSA is probably like 20% of what we do. So digital DSA digitally sources, let's say, a customer for a bank. It fills a lot of the required information and then sends that lead as a package to the bank. And then the bank decides what to do with that customer. And if that customer converts into actually a paying customer, then the digital DSA gets a commission. Our world is different. We take responsibility for not only getting the customer, but taking the customer through the entire onboarding journey on our app and our ecosystem. And once they're onboarded for a particular product, because of the deep integration that we have with our own NBFC, any other NBFC, or basically the backend money movement channels, the entire ecosystem of using the product, not only just becoming a lead for a bank, but actually coming on board, verification, digital signatures, KYC, using the product, transacting the money by pressing buttons, repaying, managing your bills, payment reminders, the entire money movement transaction experience flows through us. The processes created and managed by us. So depending on the backend banking system or partner, or whether it's our own NBFC, the level of integration, the level of complexity varies. You have to take into account the regulatory requirements, compliance, complexity, cybersecurity, and so on. But within all of those constraints, managing the entire product experience for the customer end to end life cycle and retaining and maintaining that customer in that product ecosystem for several years. That's what we do, which is very different from a digital DSA whose job is only to source a customer, send it to the bank, now go to the next customer. Source and hand off. So we don't do source and hand off. Customer
Give
comes to
me
Freo, they become
an
a Freo
example of
ecosystem.
who's a digital DSA, like in the fintech ecosystem, like India Lens.
Yeah, yeah, I think they would be. I think then India Lens could be, there could be, let's say, Andromeda, which is a traditional DSA. If you're buying insurance policies of, let's say, a policy bazaar, where you say, oh, I have an HDFC or Go insurance policy, they are like a lead generation for the insurance provider in that sense. So they play an important role, but that's the role they play. They're not the product. The customer does not buy the product or get product through them. As in that they don't exist on their ecosystem end to end. They're just responsible for sourcing and handing over.
So who does underwriting in your case? And I'm sure this would have evolved, but
yeah, I think it has evolved tremendously for us. Today, lending is just one vertical for us. And within the lending vertical, we have multiple partnerships. In the cases where our own NBFC is used, we obviously do full underwriting and collections. In cases where we have risk sharing and DLG arrangements with bank and NBFC partners, there the underwriting is done by us and collection is done by us within the definitions of what the regulator allows. And then there are certain commercial arrangements where the underwriting and collection is done by our capital partner. Then we are only doing the other aspects of the product onboarding, transaction management, and retention and repayment management and stuff like that. So I think various products, backend formats for the customer, it's all the same. They don't understand what's happening because they are coming and experiencing it on a free. They're pressing buttons, they're getting the value. But and the backend, multiple ecosystems. But we have a full-fledged risk, data science, collections, analytics departments, because now we have to cater to all of these aspects of financial services ourselves.
Okay, you spoke of a DLG arrangement. What is a DLG arrangement?
There is like a digital lending guideline as laid out by RBI, wherein when you are doing digital lending, credit to customers in partnership with banks and NBFCs, it's essentially a commercial model that you can get into, wherein you can share risk and revenue within certain constraints laid out by the regulator, so that both the bank and NBFC and the digital partner, everybody has the right level of skin in the game. So there's some constraints and guardrails laid out by the regulator. That's what I was referring to.
And this was earlier called FLDG.
That's right. So it's a first loss default guarantee. So now the digital lending guidelines lay it out, saying what is first loss default guarantee, how much of it is allowed, who can get into these kind of agreements. So this all comes under that umbrella.
Okay, understood. So the spectrum of how a fintech works with a bank would be like, on the one side is where the fintech is taking no risk, you get paid per loan, which is the digital DSA model like an India Lens would do. And then on the other extreme is where you are sharing risk and you give them a first loss default guarantee that in case this portfolio has default for the first 10 out of 100 rupees, I am responsible for that, where you get a bigger share of the spread. So is that the right way to look at this? Like it is a spectrum?
Yeah. Yes, I think broadly it's correct. Like, so one end of the spectrum, you don't have any skin in the game, to speak very broadly. And so you get some upfront share of revenue. But because you don't have skin in the game, you have no power to control the downside or the risk in the business, which means you're not investing in collections and underwriting and you're not being held accountable for that. So you can just get some upfront earnings, but beyond that, you won't get anything. Now, on the other end of the spectrum, obviously, is that if you do everything on your own balance sheet as an NBFC, but somewhere in between is the digital lending framework wherein you can do some risk sharing between yourself as a fintech and, let's say, the regulated institution, and therein you commercially decide what kind of underwriting, what kind of collections, and what kind of revenue sharing, loss sharing we will do. So it's a complex structure that is put together, then approved by the boards of both the sides of institutions, and that's put into play. So that's like sitting right in the center. On one extreme is no risk, so just some minimal revenue sharing. On the other side is obviously full 100% risk as your own balance sheet as a very traditional bank or a traditional NBFC. And the complex reality of fintech and bank partnership is somewhere in the middle.
Okay, understood. And what's an LSP?
So LSP, like a loan service provider, essentially, who's not really a regulated entity per se, might only be managing the front end experience, plugging into a regulated entity from a technology integration standpoint. So any loan being offered, credit line being offered, there is a service provider. It could be a tech company, software company, which is managing the app and everything else, but has no compliance, no risk, no collections ownership. So a pure service provider from a technology solution provider, enabling that loan to come to the customer. So that's an LSP. But you could be an RE, which is a regulated entity, which is something like us, who actually has a license. So you, as a RE, you can be an LSP also, wherein you manage the experience and everything. But the moment you become a regulated entity, then doesn't matter whichever partnership you get into. As a regulated entity, you can get into a digital sourcing partnership or a first loss default guarantee partnership or any partnership, but you're a regulated entity means that you're completely under the purview of the regulator. You can take on any format, but you're under full scrutiny of the regulator. And it allows you a lot of privileges, but it also comes a lot of responsibility and scrutiny and transparency and compliance costs. So that's how it works.
Okay. And what is the counterpart to LSP? Like you said, one is LSP. What would be the other?
So it's a financing partner, FP, which is a financial partner, so loan service provider, and now the other side, the financing partner, which is the actual balance sheet owner. It could be the bank or the NBFC or some other fintech which has a regulation, which has an NBFC license also.
Okay. And is there a TSP also? I believe I've heard this term sometimes.
There's a technology service provider where it could only be let's say a technology solutions provider, which is providing some tech stack or some solution to a larger bank for helping them with some of their core functions. It could be for developing algorithms, data analytics, and so on and so forth. So the TSP is essentially a technology service provider, which is treated by most banks, unfortunately, as vendors or pure technology partners, because they are not putting their brand in front of the customer. They're just providing technology rails and a stack to the actual financing partner.
Okay, well, like a Decentro or an M2P, these would be.
Absolutely.
Okay. Understood. When you got your first partnership going, were you also doing the underwriting, or were you collecting data, sending it to the bank? They were doing the underwriting. Like was it FLDG from day one, or
No, not really. Yeah, I mean, not really. We were not at all doing FLDG from day one or taking risk. I think our thesis, and thankfully our good judgment in hindsight, was that we knew that there were some things which we did not know, which is underwriting, collections, actually how risk functions work. And we were very clear about what we didn't know. And because of that, we decided not to take capital risk in the first couple of years of our existence. We only wanted to take operational and consumer risk, which is to say that the risk of acquiring a customer and then losing the customer, online retention, funnel management, operational risk. Can we actually manage the technology and the operational process of KYC, form filling, online experience, owning the customer journey, gaining the trust of the customer? So operational risk was there, where you could actually make a mistake operationally and just lose the customer, your product flow could break. Consumer acquisition risk was there, wherein you would acquire a customer, but you don't know which channel works, what cost works, what strategy works, and you could lose the customer or you could incur very high costs. So we decided to take those risks and not take capital risk, because capital risk is like it has a long tail element to it, which you find out only later on. So what you give up when you don't take capital risk is you give up potential upside. So, and it's fair. You're not taking down, you're not offering downside protection. You're not really having skin in the game as far as the capital is concerned. And so you should not be allowed to take a larger share of the earnings of the pie. And that is what we decided to go with. We decided not to take capital risk in the first 2 years. We wanted to learn the journey from first principles and understand what works, what doesn't work. So we used those first 2 years to not do underwriting, but manage everything else in the entire journey of the product, customer experience, the entire customer app funnel, and learn everything and look at the data, the transaction information, and then reverse engineer wherever we thought we had gaps, and eventually learn and understand underwriting. And that's how our journey started. Maybe after 2 years is when we took the first step of getting into FLDG arrangements and some kind of risk sharing arrangements, but not in the first 2 years.
I can see you raised like a 9 million round from Sequoia and Prime. So you probably would have started taking on risk after that round.
That's right. I think the Series A is when Sequoia came in back in 2017, I think. And I think that was the first time when we thought that by this time, we had enough learning in place. We were generating revenue. We knew what was working, what was not working. And that capital allowed us to invest in the research and experimentation required to start your underwriting journey. And that's what we did.
What was a tougher problem to solve? Finding supply, which means partners who will co-lend or lend, work with you to lend to customers, or finding customers?
Supply, definitely supply. I mean, demand was not really the toughest one. I think you realize with time that in financial services, capital is the raw material and capital is the product. And capital is also used to process the transaction cost to convert that same raw material into the products. Financial services is pretty simple yet complex because of that reason. So it's a supply constrained industry, because the way you price the capital, that has to align with both the capital provider and the demand, as well as the business which is offering the value. So if you cannot get the capital at the right scale and the right supply, then you cannot sustain or even get on a growth path. So capital definitely far more difficult, because the bar of convincing somebody to become your capital partner is way higher. Not difficult at all to get demand. I mean, you can step out of let's say in Delhi in Connaught Place, or in Bangalore in Whitefield, or Bombay in BKC, and catch 1,000 people and immediately give loans. So that giving money is not a problem. Demand was infinite. Right. It still continues to be infinite.
Interesting. So essentially what you're saying is that if you're able to lend at 18% versus if you're lending at 24%, so if you have a better rate of interest at which you're lending, you'll automatically get demand. The key challenge to solve is to find capital which will allow you to lend at a better rate of interest.
Yeah, I think there is capital, honestly, available for all rates of interest. But then the risk-adjusted return is a matter of personal preferences for a lot of institutions. There might be some institutions which only care for risk-adjusted returns. So they want, let's say, 12%. Beyond 12%, you can do whatever you want. You can charge customers 16% or 24% or 28% or even 17%. They want 12%. So as long as you can service that 12%, they're happy. That's one way of looking at it, which is because those institutions only care about their risk-adjusted return. Then there is a second.
How do you define risk-adjusted return? How do you calculate that?
So basically, all the risk you take, like how much risk you're willing to take to get how much return. right? So, you take
Like
little
the
risk and you get little
NPA
return. And
NPA is the risk percentage. Like when you say 12% risk adjusted return, that means what? Like uh,
yeah,
interest
so
rate
essentially,
minus
yeah, so
NPA.
yeah, that's right. So basically, the capital provider is saying that, look, I want 12% in this scenario, risk adjusted return being 12%, saying that there can be additional costs, credit losses, whatever it is, I want 12%. Because this 12% covers my own internal costs, which I know are always going to be maybe, I don't know, 8%, 7%, 9%. So the 12% is what makes me happy. My P&L is okay. So for these financial institutions, it covers their costs and it gives them sufficient markup, which allows them to create a profit pool. So for them, this is how it works. And then there's a second category of capital providers, which care a lot deeply about the individual credit losses and the costs, not just about risk adjusted return. So you can tell them that, look, you will, I will give you 18%. And your cost of capital might be maybe, I don't know, 10%, but I'll give you 18%. So you're sitting on an 8% fat margin, but they still may not like it, because not only do they have to deal with their own costs and while they're getting some profit, they also have to worry about how their uh, losses look on paper. So you can say I have high losses, but I have very high profits. For some people, this is not aligned with their internal board strategy. They don't want high losses and high profits. They want low losses no matter what, because this affects how they themselves raise capital from the Reserve Bank or from capital markets globally. What they make on top of their costs and losses is just one part of it. But inherently, what losses they have to show is a consideration factor for them. So there are some institutions which hence not only care about risk adjusted returns, but they also care about the absolute risk and the absolute costs. So yeah, I mean, it depends on who you're working with. So at the end of the day, every commercial structure, every commercial arrangement becomes potentially different.
And credit cost here means losses or NPAs, like when you said credit costs.
NPAs are probably the most significant part of the credit costs, but there are also other
What
credit
else is
costs. You have to incur the credit costs of actually underwriting the customer, onboarding the customer, pay for the bureaus, pay for verification, pay for other checks that you do for the underwriting process. So all of those are part of the credit process. Losses are one part of the credit process, but the credit process is also a lot of things that you do, and you pay for those, verification, fraud, income check, bureau check, KYC check, and a whole bunch of other things. So costs are incurred over those. So that put together creates your entire credit cost bucket.
Okay, understood. When somebody is saying that I want just a 12% risk adjusted return, so that would typically be where they would have an FLDG. I mean, in an FLDG arrangement, does the lender report the losses on their books, or they just report what they earn net?
So RBI came up with some regulations which created this clarity, the digital lending guidelines. Before they came up with the digital lending guidelines as a very clear policy, before that, the capital providers were not necessarily reporting the losses on their own books because they did not have any rule which said that they needed to. So they could not report the losses on their book. They could only show the actual cash settlement that was happening based on the first loss default guarantee. But post this new directive that has come out on the digital lending guidelines, it is very clear that the capital provider needs to show the non-performing assets on their capital, on their balance sheet, irrespective of who's paying for those losses, whether your fintech partner is paying you cash for that, or whether you are paying for it, or both of you put together are sharing that loss burden, is a separate matter, which is a P&L matter of how you manage your loss bearing cash flows. But the fact that you have customers who have not paid, irrespective of who covers for those damages, you do need to show it. Post the digital lending guidelines has become clear that capital providers need to show the credit bad assets on their asset on their book. So this created more transparency and more accountability on capital providers. So they can't just say that all I care about is risk adjusted returns. Now they actually will have to show those bad assets. They have made profit net, but they still have to show those bad assets in their entire portfolio collection somewhere. So it might not be a bad thing for the P&L. The profit and loss statement is still in the green, but it will show up.
Interesting. So as a fintech, then risk management becomes a major competitive strength, because no matter how high a rate of interest you're able to lend at, I mean, let's say you have strong distribution, and so you can lend at a very high rate of interest. But even then, if you don't control losses, you will not get capital.
That's true. And I think the reputational damage and the reputational loss is far more difficult to recover from than the capital loss. The capital comes from somewhere eventually, right? Somebody marks a red on their ledger and deals with the issues, and life goes on. But the reputational loss that you as a team did not do a good job, that is very difficult to reverse. So I would say, credit risk is a very complicated business. It can be very rewarding if you do it right, but if you don't do it right, it's a very high punishment business. So in that sense, it becomes a competitive advantage, and you need to continuously invest in it as well.
What's like what's like the most powerful kind of moat a lending fintech could have? I mean, you could have a distribution moat, like say Paytm has a distribution moat, or you could have a risk management moat, or you could have a collections moat. So between these, or there might be others I cannot think of at this moment. But what do you think is like a powerful moat for a lending fintech?
I think it's a combination of these few things. You kind of almost called it out in some way. I think a very strong underwriting engine, a very strong analytics engine is definitely one of the strongest moats, because it works on compounding effects, which only develop over time. So as you do good underwriting or bad underwriting, the learnings from those actions come to you much later. The reward or the punishment comes later. So 6 months later, 9, 12, 18 months later, you actually learn. So you have to be patient. You have to wait for the feedback loop to kick in, and then go back and correct the mistakes that you made 1 year ago. That is the reason why a very rapid scaling in lending is always something you should be wary of, because it's very easy to distribute money and say, I scaled up and grew 100% quarter and quarter. There is no competitive advantage in scaling up 100% quarter and quarter in lending. So I think a strong underwriting capability, very strong data science and analytical capability is definitely one moat. I think this is one, but there are quite a few of them, right? I would say maybe they're all interconnected in some ways. So access to capital and an innovative product stack definitely would make two others. On top of that, then a smart distribution strategy. So if you put it together, like if you have a very good product stack, then you can stand out as a product company, and because of that, you would be able to attract customers, which would then allow your distribution to kick in as a huge advantage. And once you get customers at a lower cost, then you can offer them credit at a lower cost, because your inherent costs are low. And because you offer credit at a lower cost, you actually increase your margins. So you can experiment more, and in the same time frame, you can learn more, and which allows you to further improve your credit engine way better than anybody else. So it's like a flywheel that gets kicking. So I would say a combination of all of these things.
Okay, super interesting. What is your distribution strategy?
Well, because we're a digital platform completely. And as a platform, we reach out to customers across the length and breadth of the country. First of all, I think the access that we operate on is completely digital. All right. So we don't have branches where customers can walk in and apply for our product. Within the digital platform or the digital access that we operate in, there is the organic channel wherein customers are looking for a product. So today, they could be looking for a credit card, or they could be looking for a, let's say a digital savings product, or an FD investment product, or a credit line product. So like, let's say 5 different products. And when they search online, they look at answers and we show up because of brand word of mouth, like tons of customers. So organic is one, wherein we get a lot of inbound traffic based on customers' natural searches. Then we have other channels. We have search engine marketing, search engine optimization channels. We have paid performance marketing. Performance marketing is the most obvious one, wherein a lot of companies spend a ton of money on channels such as Google Ads, Facebook ads, and various other social platforms where ads are allowed. And that in turn allows you to show up your product over there. For us, this is a very small part of what we do. We today have the overall paid acquisition strategy is in low single digits as far as overall percentage contribution is concerned. Yeah, more than 50%. I think we've seen this going up to almost 60, that is 60% of the customers sometimes come in organically. Above 50, but sometimes 60 plus.
Then we have an indicator of the product stack.
That's right. I think over the years, a lot of we've deliberately taken on some pain earlier on. Said that, look, we will not fall into this trap of using this acquisition strategy, because if we continue to do that, we will never learn how to do this. So we try to stay away from some typical investor-led, funding customers, cashbacks, and free discounting kind of strategies. And because we did that, we would not get customers coming in for free. So we were not fooled into believing that we would succeed just because you have customers knocking on our door. We have customers knock on your door because you're probably bribing them. Of course, it leads into something good, because then, if your product is really good, they are able to get used to it and you're able to create habits. So that there is merit in doing that. Cashbacks, let's say a wallet or a UPI, they're cashbacks and there is value. But we decided to stay away from a strategy early on where we would spend a ton of money. And we did spend a lot of money early on when we started the first couple of years, paying all these channels. But then we realized that if I were to scale up this business, there has to be a lot of pull coming in from customers. You cannot create a long-term, sustainable, respected brand if you cannot create pull. So then you need to work on the hard problems. You need to let go of that addiction of free customers, free money getting distributed. You need to let go of that. And then the pain you have to take is that, okay, now I have to prove my worth to the customers. The customer has to choose me over 5 other solutions available. It is not a winner-take-all market. So it's very clear that financial services is not like that. And it's not going to be like that also in a developing economy, at least not for the next 10 years. But we still had to outshout, outconvince, outprice sometimes. But we are doing basis on the strength of the product and strength of the experience, the process. And we failed miserably in the early years. And we've taken harsh decisions, gone back and then relearned from our mistakes, kept doing it. And at some point in time, we were quite frustrated because we saw a lot of other companies actually, climbing up on their customer acquisition numbers because they were spending on IPL ads and TV ads and front page newspaper ads. And we were questioning our judgment on some days. Like, we wake up in the morning and then you have just watched an IPL match yesterday. And then this morning you wake up and you see a front page ad and you think that, are you really doing the right thing? It looks like everybody is doing the exact opposite of what I'm doing. So we've had days where we've been like quite consumed with self-doubt on that strategy, but we stuck to it. And the result is that today, more than 50%, like I said, on some good months, up to 60% of my acquisition is organic. Products across our pay, save, borrow vertical, whatever we've created, are appealing to customers. We have a long way to go, obviously, to improve a lot of these things. But we see customers using our products across more than 16, almost close to 17,000 pin codes, which is about 85% of India's pin codes, across 1,200 cities, from Jammu to Andamans to Kutch to Arunachal Pradesh, across the length and breadth and footprint of the country. But yeah, I mean, this has been painful. But now I think that pain has paid off. A little bit of upfront pain was required to get here.
So what are some of those lessons you can share on building a good quality product?
Yeah, I think you have to be honest to yourself as a product team. It's easiest to fool yourselves. I create a cool design. My close friends and family love the product, and looks like I'm able to get a lot of likes on some social media post around this, and I got called as a participant in a panel or a startup competition. So many signals telling you that it's all coming together for you, and you kind of arrived as a product. I think you have to ignore all those signals. These signals push you into thinking that you have created a product that works. The ultimate test of a good product strategy, a good product building strategy, is that you need to be very, very clear of who your customer is and what does this product mean to your customer. How is it changing their life? Is it just making their life better and they're okay if it was not there? Or is it dramatically improving? And what does it mean? What does your product mean for your customer? And then based on that, you go back and rethink. It's not about cool designs. It's not about bad designs and just purely low cost also. So it's not like, okay, design doesn't matter. The only thing that matters is affordability. I'll undercut everybody and I will win. No, they're not really. Because over a period of time, that's like a race to the bottom, right? And you don't want to play that game. You don't want to win that race ever. So I would say a good strategy in product development has been be intellectually honest to yourself. Like, don't lie to yourself as a product team. Don't drink your own Kool-Aid into thinking that these signals are all pointing to coolness, which means my product is successful. Second is, the product has to stand on its own legs. You cannot buy your way into product conviction. So the product might be valuable, and you might be intellectually honest with yourself, which is to say that this works, this doesn't work. So I can't do those 10 things because somebody told me, or it's a cool thing in the US and in India also it will work. No, I'm intellectually honest. I've created something. But the problem in this situation also is that you can still put the product in the customer's hand and they might be willing to pay for it. But over a period of time, they may not. Because they realize that this is not really making sense for me, right? So, for example, if take like the simple example like ordering cabs for local commute. Right now, there was a time when we all would not think twice before doing it because it was the most popular solution available everywhere. And you had more and more cabs and better experience coming up every month. But somebody was paying for it. Probably the companies running the service were paying for it. They were incentivizing the drivers so much that the drivers would show up on time. Over a period of time, some of that advantage gets depleted because you stopped buying your way into quality, or you stopped buying your way into convincing people that this is really dramatically better. And then that shows up. So at the moment you withdraw that incentive, you stop buying your way into people's minds and hearts, then over a period of time it shows up. So I think that is the second big learning for product development, which is like, don't buy your way into people's hearts and minds very early on. So I think I would say these two broad things. One is intellectual honesty about what works, what doesn't work, what is needed in your product. And once you even create that, you might have a great product, but there just might not be any commercial market for it. I mean, it can be a part of something else, but don't be married to the idea that you will create a great business out of this product because the product works. Product still may not work. But I do think that in financial services, particularly, you have to make money. It's not just about a cute product. You have to make real money. So in financial services, you can't and you should not buy your way because you will not be able to sustain it. The tap will run dry someday. These two big things.
What all products do you have today? So you, of course, started with a lending product, the line of credit.
Yeah.
What all do you have today?
Yeah, so I think we diversified from lending, and you said that, look, our ambition is to not just be able to help people when they need to borrow money, but because I understand my customers well, their core financial needs, which are the most frequently occurring needs, are what we want to solve for, and they became broadly pay, save, and borrow. So on the pay side, we have co-branded credit cards, which helps people pay. So partnership with banks on Visa, MasterCard. Very soon we are going live with our RuPay. RuPay is already out there, but it's on very small testing scale right now. Very soon the RuPay card. We have our, we got our UPI license. So very soon you will see our credit on UPI product also going live in the market along with our own UPI. Just like you have a UPI solution available, like Google Pay, Bheem, Phone Pay, you would have an UPI from Freo also working. The idea is not to become yet another UPI player with giving tons of cash back. The idea is to have a UPI transaction layer wherein customers can use it to pay, but then we build a credit on UPI convenience product on top of it. Not mainstream credit, but a convenience product. On the save side, we have a save and grow philosophy, wherein we are able to create digital savings, fixed deposits, recurring deposits products for customers through our app ecosystem, where they can save and grow their surplus money. And this is the newest vertical right now. Other than the pay vertical, where credit on UPI is just in the testing phase and going to go live, as a vertical, the save and grow vertical is the newest kid on the block. But the idea is that the same customer should be able to also put some surplus money aside and make sure that they can save it and grow it in a traditional manner. And then they have the borrow vertical where you
have fixed deposits or NBFC fixed deposits? Or
both. Okay. Right now we have bank and we're expanding. You'll see an array of bank and NBFC fixed deposit opportunities coming through Freo to our customers. And we'll obviously expand further on that. We'll be a little selective in the early days in terms of what to offer based on what's meaningful for our customer segment. We don't want to do everything because that's the worst thing you can do, create clutter and just confuse your customer segment. And then the third vertical, which is the borrow.
Right. Okay. Who is your customer segment? After which I have a follow-up question.
Sure. Yeah. So the customer segment, probably the most important question for us. I mean, we obsess over this all the time. Our customer segment is the middle income India. This is not the top 50 million people, so to speak. This is not the, from an income level standpoint, this is not the bottom 500 million people. This is the population segment sitting right in the middle, which potentially could be like, I would say anywhere between 70 to 100 million households. It could be anywhere between 350 to 450 million individuals as part of those households. People call it middle class, call it middle income, but this is the middle segment sitting over here. This is growing rapidly. The segment will probably by 2026, 27, this will become like 500 million people. So you're looking like almost 100 million households with an average of 4 to 5 people per household. Right? So 100 million households, let's say. That's my customer segment. And again, this is people city who have spread across, not really only tier 1. Today we have customers from tier 1, 2, 3, and 4. We, like I said, we're 1,200, right? 1,200 cities and towns is where our customers come from today. We believe that we will go to about 5,000 cities and towns But the digital adoption is faster in the tier one and some of the larger tier two towns. It's faster adoption. And also because some of the bank partners that we work with, they also feel very comfortable servicing customers from these tier one and tier two locations. So it's like a kind of a mixed bag over there. Again, these are all individuals who are mostly having regular income. They could be salaried, they could be self-employed, they could be small business owners, but as individuals, they have regular income coming from whatever source. Uh, I think mostly male customers today in our current ecosystem, but we are reaching out to both male and female without any, there is no algorithmic disparity or selection bias that we have. We would love to have more female customers, but we think that majority today continue to be male, and we see a massive opportunity over there to tap into the working women population of the customers over there. And yeah, I mean, these are customers who could be typically between the age group of typically between 25 and 40. The statistical median ends up around 30 to 32 years old. That's a statistical median. But between 25 to 40 is the broad. We already obviously have people who are above 45, 50 years also as customers, and nothing stops them from coming. But we see the volume coming mostly between 25 and 40, spread across all locations. So yeah, I mean, that's the broad middle income India customer segment.
So the reason why I asked you the segment is I was curious why you selected fixed deposits as opposed to mutual funds. And I mean, mutual funds would be like the low hanging fruit, much easier to launch. Whereas for fixed deposit, I believe you would have had to go bank by bank to offer fixed deposits. Whereas with mutual fund, I'm sure there is a way to just plug and play and start selling all mutual funds in one go.
Yeah, I think I think your hypothesis is correct, Akshay, in the sense that mutual fund is also a faster growing segment, and there's a lot of natural affinity for our customer population. But the other part, which is that it might be easier to do, has not entirely been the case for us, because having worked with bank partners for a whole bunch of other products, it was naturally easier for us to extend the fixed deposit and RD route. But the mutual fund part is in the pipeline. This year, you will see that part also coming into the picture. So like I said, this is the newest kid in the block, that save and grow vertical for us. So we're still taking shape. It's like a clay that we are molding. So some parts might become not the heroes so much. They might become side actors and supporting roles, and some might become bigger. We're figuring out which is a supporting actor and which is the leading actor right now. I think this year will tell us.
Okay, understood.
Some of the numbers, more than 2 million customers on the Freo platform, more than 20 million, I think close to 22, 23 million app installs and users in our Freo ecosystem. And I think more than 12 active capital partners, bank and NBFCs, large scale institutions, all put together active, and probably the same number of partners in the pipeline at different stages of early stages, gone live, not mainstream yet. Some are in beta testing, some are in tech integration and testing phase. So like that.
Okay. I want to ask you a slightly hard question. Why not just focus on lending? And the reason why I'm asking you this is because if you compare yourself with your peers, like say Five or Credit B, similar vintage, but I think both of them have much larger books.
Yes.
So, you know what?
Yes.
So, I mean, there is so much opportunity just in lending. Why not just focus on that?
Yes.
Why? I mean, these might just seem to be distractions.
Sure. Yeah, I think it's a good question. It is a very good question, Akshay. And honestly, like you rightly said, because it's a tough question, we obviously have thought about it the most. So it is the answer is not easy, but it is very simple for me to give it, because I have thought and obsessed over this over the years. It's a combination of a couple of things. One is that it's a combination of One is that it's a function of our ambition and our DNA. And I think that is the dominant reason here. So there is no problem in being a lending only business. But we don't see ourselves playing this game in the long term as being a lending only. And I particularly have a way of thinking this. I don't want to play a game where I don't have a long term advantage. Right? Just no point playing that game where you don't have a long term advantage. And if you want to be a lending only franchise, you have to have a cost of capital and then capital access advantage over everybody else. And unless you're a bank today, which has large and massive deposits, you don't have that advantage today. Right? In India, as a society, most businesses in financial services are still solving for financial access. They are not solving for spread maximization yet, which is the case in, let's say, a developed economy such as North America. So US market says that, oh, well, the cost of capital is 3%. So if somebody can get the cost of capital down to 2.5%, it's very valuable because it's already so competitive over there that you've eliminated cost of capital as a variable, right? And you don't have a spread. You don't have an access problem because in a population of 350 million people in the US, you have close to 1.2, 1.3 billion credit cards already. You have more than 1,000 institutions over there which have some form of banking license, digital, full-fledged, partial, so on and so forth. India is very different. So you're still solving a distribution and access problem today. And it is not going to be intuitive for a company like me to create a natural advantage of capital. My access to capital will be dependent on my ability to do equity raise, debt raise, access capital markets, both public and private, constantly. So I will be constantly running on a treadmill, which is not my natural strength. And capital is the raw material. It is the supply constraint. So I would rather not play that game where that is the dominant rule that I need to operate by. And when you get into lending only as a franchise, that is the second part. Right? One is the DNA. The second part is that the lending only, it then forces you to play by a certain domain. So you have to get into secured lending over a period of time. You cannot only do unsecured lending because the climax for a lending business is that for a very long period of time, you can't stay private. Your books become large. The regulator wants you to become public, and access to capital will only get cheaper when you get into public markets over a period of time because you need capital. And when you get into public markets, unsecured lending does not value revenue as well as secured lending. The price to book ratio, the multiples are not very strong on an unsecured lending book because the quality of revenue over a long period of time is not that good in unsecured lending as compared to secured lending. So you will be forced to get into other lines of businesses. So you will have to force to get into loan against property, business loans, home loans. Then you are playing a physical underwriting processing game. You cannot do loan against property by creating an app. You have to visit the building and look at the fire and the BMC approval plans. So that is a different DNA required of running that operational game. So a different muscle needs to be exercised. And I have not flexed that muscle by choice. So it's a combination of my DNA, it's a combination of my ambition, and it's a combination of the fact that I think that our customers have far bigger needs than credit, and I can actually create a digital bank of the future by doing this. And if I were to be doing only lending, I would be selling myself short. Today, you walk into a branch of a traditional bank, you walk to a counter in that branch and you talk to one teller for some service. You go to the next person, next desk. You could be something else. So you could be depositing money. You could be inquiring about a home loan. You could be asking about fixed deposits. You see that there is also an insurance desk. You are talking to them. And then you're also saying, I want to also, by the way, check out what credit cards you have. right? So you have 5 different things that you do when you walk into a bank branch. A digital microcosm of this branch experience is what a typical digital banking platform should do. A future bank will be this, right? Banking will exist, banks will change in avatars, right? There was a time when 90% of people's savings deposits used to sit in public sector banks. It's not the case anymore, right? More than 40% today sit in private banks and growing rapidly, taking share away from public sector banks. So neo-banking as a definition is not about digital banking. The problem is that we want to believe in a certain definition as a larger industry, that this is what neo-banking is. But it is not like that. I think the digital representation of a bank is yet to play out. And I see that as a massive opportunity, because it is up to me to create that impression and value in front of the customer, saying, look, these are the 3 or 4 things that you care about as a family, as a household. And I'm going to bring all these 4 values to you. For example, what is very clear to me is actually counterintuitive to what most people write about in neo-banking, which is that I do not want to become a primary digital savings account offering to my customers, which is a premise for a lot of neo-banking players, saying neo-banking means digital account. I actually operate with the thesis that the digital savings account that I am going to offer to my customers should at best be the secondary or tertiary account for them, never the primary account. Because the secondary and tertiary account comes from the younger generation in the family. They link that to other values, saying, I have a card and I have a deposit or a mutual fund. I get surplus money in this. I can draw it into a mutual fund or a credit line, which can get money here. So the value of money in a household is rapidly transforming. It is not centered on the savings accounts of that family. And the one fundamental flaw that as an industry we have been making is that we are thinking that neo-banking means the core value of a savings account has to be just transformed into a digital platform and that becomes neo-banking. It does not. Banking means so many things. From the time you get up in the morning to the time you sleep at night, you deal with different ways of money transaction. That is a holistic view of banking, and that's my approach. And as you will see very soon in the first quarter of the new financial year, which will start probably from next week onwards, you will see us coming out with some numbers that we will disclose, which will tell you that we are probably one of the largest digital banking platforms, or neobanks, as you might choose to call it, with some of the best financial metrics in the country. But that is made possible because of the thesis that we have. Today, we have a bunch of licenses. We have NBFC license. I have a PCI DSS certification, which allows me to store cards legitimately, numbers. I have a UPI license already, and I have a couple of more regulatory licenses already in the works and the pipeline, which will come out this year. So I will be operating with 4 or 5 licenses as a platform. So that then makes a holistic picture for me. And eventually, as and when the RBI decides to come out with a digital banking licensing regime like Southeast Asia or some of the other economies in the world, we will probably be the first in the queue to get that. But I'm not predicating my future success to that. My success is based on replicating a physical bank branch experience into an very affordable, convenient app ecosystem for the customer, where every product is licensed, regulated, and transparent. Whether it is lending, whether it is a credit card, whether it is insurance, every product comes with a very clear licensing, safe regulatory framework to the customer, and it is sitting inside one Freo ecosystem. That is what a digital bank of the future will look like. And I think we will be probably one of the first ones to give shape to that.
So could I say that you are a cred for the Aam Aadmi? Like cred also has a similar mission, right? Like for the top 25 million customers of India, they're building an all-in-one platform. You're doing that for
I think, let me put it this way. I know the folks at Cred, very good friends. I think maybe in a light-hearted way, I can say that Cred is eventually going to become the Freo for the premium one, top 1%. Let me put it that way.
Yeah. Okay. Nice. Okay.
But I can say that because I have a lot of respect for the folks at, good friends at Cred. So, I can say that with a straight face.
Amazing. Awesome. Thank you so much for your time, Kunal.
My pleasure, Akshay. Nice chatting with you as always.